High Mount Research Market Insights video for July 20th, 2023. Hey everybody, Willie Dowitch here. Glad you have tuned in. Glad you are listening. It's July, the middle of July, the last part of July. The market is pretty quiet. The world is pretty quiet. People are on vacation. They're out of the office. So the theme for this week's 3 for Thursday video is quietness. So as we go through, you'll see we're talking about quiet strength from stocks, this lack of volatility that we're seeing, accompanied by more stocks making new highs and new lows. A quiet struggle for the economy. So if you look at these economic surprise indexes, for example, you think things are going really great. If you look at nominal data, things seem to be going okay. If you look at actual activity, there's a different story that gets painted there. And then not so much quiet, but just a ongoing theme of kind of what's coming up next from the bond market. The Fed meets next week. 2-year yields are pivoting again. I think this is in context of the bond market missing a larger turn that seems to be occurring in the economy, in the bond market in terms of yields as well. So let's get into the charts. When we talk about quiet strength in the stock market, one of the things that really comes up is this lack of 1% moves in the S&P 500. 12 days now since the last 1% move, meaning we haven't had a 1% swing up or down in the S&P 500 yet this month in July, in all of July. And you can see we had this run of 7 days late last year. That was kind of a warning that maybe something was changing. Now, as we moved in through the second quarter, now into the third quarter of 2023, those periods of quietness are starting to be more pronounced, more extended. So again, 12 days in a row. That's the longest that we've had since late 2021. In strong markets, quietness is to be expected. Think back to 2017, one of the best years in the market, certainly in my memory. You had very little day-to-day volatility, upside or downside, but yet it was just a steady churn higher, this relentless tick higher in the market. I'm not saying that we're set up for that right now, but it's just a warning that, and an awareness that quietness usually accompanies strength. Noisiness, what we saw last year and again at times this year, usually accompanies weakness. In terms of the economy, like I said, the economic surprise index recently hit a 2-year high. So data is coming in better than expected, but you look beneath the surface and things aren't as quite as quietly strong as they would appear. We're looking here at retail sales data, for example, that came out this week. Blue line on top, that's the nominal data. That's what usually gets quoted, what gets talked about. And since the end of 2019, retail sales on a nominal basis have risen at about an 8% annualized pace. Even after that post COVID reopening surge, they're still, since March 2021, rising at a 3% annualized pace. Take away the effects of inflation, you get a different story. Since December 2019, on a real basis, including that surge that we had, as things were reopening, 3% annualized gain for real retail sales. Perhaps even more importantly, since March of 2021, it's a 3% annualized decline in real retail sales. So yeah, the receipts keep going higher. The amount of activity that is being transacted is moving lower. We had more evidence of that today. The Philly Fed data came out still at these low levels that are more consistent with recession than expansion. Leading indicators, the leading index from the conference board, also consistent with recession. In fact, at a level that if it's not a recession or not soon to be a recession, you would be betting against history and assuming that this time is different. Also had existing home sales data today, dropping down not only to its lowest level since January, but the 5th lowest monthly total of existing home sales in over a decade. So the headlines are talking about economic resiliency. Beneath the surface, it's much more of a struggle. And so that brings us to the bond market and what the Fed's going to do, what the bond market thinks the Fed's going to do. And so we have here the blue line, that's a 2-year yield. Orange line, that's the Fed. You can see the Fed's just kept raising rates. It paused last month, is likely to raise net when it meets next week. And based on the latest data from the Fed, likely to raise 25 basis points at one further meeting yet this year. The bond market doesn't believe it, but the bond market has struggled to know which way to look really for almost a year now. What we're seeing is the fifth pivot in the 2-year yield since October of last year. So it ran up, thought rates were going to go super high, turned lower. Nope, we're going to go high again. After SVB, the banking crisis earlier this year, there was pretty considerable consensus that not only was the Fed done, but they were going to have to be cutting sooner rather than later. As that banking crisis didn't expand, then okay, maybe they will raise, and now we're starting to see this expectation of cuts again. What I think is missing from this, and missing from the broader discussion about rates, is the longer term trend in yield. So we're just looking at this over the past couple of years. Take the 10-year yield stretching back into the 60s. We're in the most sustained period of a rising trend for yields since the late 60s. We're starting to make higher highs in terms of yields. And so we're at this important pivotal turning point in terms of bond yields that these shorter term swings start to overlook, don't really pay attention to. And so then what does that mean for us from an asset allocation perspective, given these concerns that we have out there, given that we have a weight of the evidence that's still weighted more towards risk than opportunity? I think it pays to pay attention to the message of the market here. And that's what we try to do via our Blue Heron composite allocation model. So just as a refresher, this is based on a US equity model that gives us our allocations for large cap growth, large cap value, mid cap, small caps. A global equity model that gives us the allocations for the overall US exposure, and then Canada, emerging markets, and the rest of the regions. We have a bond market model that divvies up allocation within the bond market. And all of that is in context of an overall stock bond commodity model. And the current message and the current reality is, despite these long-term concerns, the trends are mostly higher. The trend in stocks rising. In fact, the only area within the global equity market from a kind of composite asset allocation perspective where a trend is falling is Canada. Bond trends, yes, we've got rising yields, but on a total return basis, bond trends are generally drifting higher. Commodities are in a downtrend. And so while we have these longer term concerns, and I think we are going to see them play out at the moment, we are seeing strength in from a trend perspective in our models. And so from a systematic perspective, we follow that strength. We stay in harmony with those trends. From a discretionary perspective, our dynamic portfolios, we want to be a little bit more cautious, especially as we go from a short-term horizon out to a longer-term horizon. So tactically, long equities, cyclically, strategically, underweight equities as some of these bigger issues that we're seeing in the economy from a valuation perspective have yet to play out, but history suggests that they will play out. So that's our 3 for Thursday video this week. Glad you tuned in. We'll do this again next week, where we try to distill some of the important topics of the week into 3 charts. After you watch the video, you can download the chart pack. There's a couple bonus charts at the end there to kind of provide a little more color to some of the things we talked about. So thanks for tuning in. Thanks for listening. Willie Dowich here. Hoping everyone has a great week ahead and a great weekend and gets outside. But you get outside because it is July after all, and things are quiet in the market, but there's lots to do out in the fresh air of summer. Have a good week, everyone.